What's up, you guys? Jason here at Students of Life, where I break down life lessons and learnings to help yourself in your life. In today's video, I want to break down the home buying process, whether you've done this before or you're doing it for the first time and you're a first-time home buyer. I wanted to share all of the things that I've learned along the way and break it down in a step-by-step process. So the first question is, should you buy a house or not, right? Do you really want to take on this mortgage, all of the, quote unquote problems with owning a house and running toilets and all the things that people fear, or should you just rent and take the easy way out? I think there's a lot of things to consider here. The first thing is really going to be about your financial situation. Do you have a lot of high interest debt? Do you have credit cards? Do you have loans? Do you have auto loans? Do you have student loans? Are you buried in debt, basically? That's going to be the first question that you need to answer. I would say, by and large, it's probably okay to have maybe a car loan, some student loans, maybe one or two other things here or there, but definitely not high interest credit card debt. If you have anything outstanding that's interest bearing on a credit card, pay that off immediately. Now, there are some cases where you may have a 0% APR. As long as you have a plan to pay that down at some point in time and not going to incur 20 or 30% interest rates, I would say you're in a good spot. Outside of that, the next real big thing to consider is understanding the market. So doing your homework. You need to come up with a real kind of long-term plan of, A, do you think you'll live in this house for some period of time? Usually most people's rule of thumb is roughly 5 years to break even on such a type of investment. Now, that's not always true, but like roughly rule of thumb, you should probably want to be there for some duration. You should also have an understanding of the market that you're getting into. Is it appreciating on average? Is it bubbly right now? Is it overvalued? Are houses seeing dozens, if not more than that, of offers coming in on it? You really just need to do your homework and get a sense of what you're getting into and how to go about it, which is, I guess, why you're here. The other thing to consider is really going to be around, again, kind of going off the plan. You want to be thinking about what are your possible exits, right? If you had to move very quickly, how would you navigate that without losing a ton of money? So the other piece of this is really going to be about what is your exit strategy, right? Are you going to live in this for, again, a long time and go to sell it and you're buying right, whether you're either at or ideally below market, which you can figure out by looking at other comps in the area? Or is this something that if you had to move or sometime in the future when you do move, you can rent out? Meaning, will it make sense as a standalone investment and be able to rent it to cover your costs and actually net some cash flow? Now, I won't get into the real estate investing aspects in this video, but it's something to consider if that's something you want to do in the future. So these are kind of the main things I would consider on should you buy a home in general or should you rent? Answer these questions, you might have a little bit more clarity. So the second thing I want to talk about is really about how do you get pre-approved for a mortgage? What does that process look like? Who do you need to talk to and how does it work? So generally speaking, you just can go to any bank. I often shop around for banks and I can talk a little bit in a second about how to find a good bank. But the first thing about getting approval is really not that difficult. You essentially go to the bank, tell them what you're looking for, tell them what price range you're looking at. And the things that they're going to be looking for that you need to be aware of is really, first of all, what is your credit score? If you don't know it, figure it out. Go to creditkarma.com or something of that sort, and you can figure out what your score is. Now, when it comes to mortgages, I would say generally you need to be at 720 or higher. You're going to get the best rates with those scores. If you're at 750, 760, you're getting the absolute best scores and you're in really good shape. Anything higher than that, I don't know, it's probably diminishing improvement in terms of the savings. Now, if you're south of, call it, 700 to 720, you're going to have a little bit more difficult time, or the bank is going to charge you a slightly higher interest rate, which is going to cost you a lot more money over time. So if you have time, I would say take the time to get your credit in a good spot, whether it's, you need more trade lines. So generally you need to have 3, maybe 4 different trade lines, meaning credit cards or loans that you pay down. You don't carry a lot, if any, balance on them. and you build a long history of, on-time payments, and like get a lot of the derogatory marks or anything that you may have had in the past kind of into the past. So you want to maintain that for some period of time, call it 12 to 24 months. Now, that's something you should be working towards. Now, if you can't do that, you can always get into one of these higher cost loans, come up with a plan to work on that over time. Maybe you can refinance at a later date, assuming interest rates are still low and your credit has improved. That is a possibility, but something to consider. The other thing that banks are going to look for is really your debt to income ratio. So when you look at your credit report, and a lot of these sites will actually help you determine this, it'll look at your debt to income ratio. Now, this is essentially all of your monthly payments, whether it's credit card, auto loan, etc., that shows up on your credit report. What is the ratio of those debts on a monthly basis relative to your income? That's your debt to income ratio. So most banks are going to be looking for something less than probably 40 to 45%, I would say, for a mortgage. If you can get much further south of that, you'll be in much better shape. I would say ideally you're probably south of 35% debt to income ratio. If you're not there yet, then you need to spend some time paying down those debts and making sure that you aren't over levered or have too much debt relative to your income, or you need to increase your income. Now, the last piece of this is really around the documentation. So this is something you should be prepared for. Banks are going to ask for a ton of documentation. They're going to want W-2s, they're going to want tax returns, they're going to want pay stubs, they're going to want bank statements. They'll probably want 3 months of bank statements. They'll probably want bank statements for every bank account that you have if you have more than one, and so on and so on. They're going to ask for a ton of documentation. You don't have to have that all up front, but as soon as you know you're going in for that, you should be ready to pull that really quickly, know where to go to get it. But with that, they're going to pull your credit. You will get an inquiry on your report. You might get a slight ding for that. I would say in the grand scheme of things, not a big deal. But again, like the more robust your credit report is, the less of an impact that piece will have. So the next question is really, how much should I put down on the house? Now, I would say most people believe 20% is the minimum required. That's actually not the case, and I think this is one of the huge benefits to real estate in particular, and this is actually how I got started. There are programs out there, the primary one being an FHA loan, where you can put down as little as 3.5% down. Now, that's not all scot-free and easy. There are some cons to it. Primarily PMI, which is private mortgage insurance, which is essentially an additional premium that you're paying on a monthly basis just to have that particular loan. Now, again, the benefit is you get to only put down 3.5% as opposed to 20%. The other negative to this is that you're likely going to pay a slightly higher interest rate, maybe 25 basis points or 1/4%. Or maybe a little bit more. So definitely look at your options, but I would say the primary thing to consider here is it's probably worth, or at least in my case, it was worth paying the additional cost up front with a PMI and the higher interest rate relative just to having the ability to only need 3.5% to buy as big of a property as you can afford. That's an incredible thing. Now, one of the other things I'll mention here is with PMI and an FHA loan, that's going to be with you for the duration of the loan, which sounds like a really long time. But the goal or the idea here is that if you're able to buy below market and or add value and that place appreciates over time and or you pay down that principal, you'll eventually get to a point where you're able to prove out that you have at least 20% equity in that, and that would allow you to refi into a conventional loan, which then you would drop the PMI and you would likely, depending on where the interest rates are at that time, you'd likely be able to get the better rates. The other aspect you can go is you can actually do conventional sub 20% equity loans. You're still going to have what is just called a mortgage insurance. That's that same idea of you're paying this additional premium. Works slightly differently, where you can actually hold that loan as soon as you prove out, I think it's 20 to maybe 22% equity in that note. Then you can actually have the bank essentially refi that out, drop the mortgage insurance, and then you're kind of back to where you want to be. So those are the options that you have in terms of down payments. Now, what would I recommend? Again, I think 3.5% is a great place to start. You have a lot of options. Alternatively, you start at something like 5%. You do conventional with mortgage insurance. You get into the place, and then you can always pay down more principal over time. Again, or you could later refi. But again, it gives you a lot of options to pay to get into the house and pay down over some time. So the next question is how to get a mortgage and where to go. So a lot of people only know that the bank that they've ever grown up with, and they do all of their banking there, and they don't look any further. I was probably in the same boat, and it actually ended up working just fine. But what I would recommend is, in my experience, I prefer to go to a lot of times the much smaller, either local community banks or smaller regional banks to start. They give the service is much better. They tend to give some of the best rates that I've seen across the board, and it tends to just work out a lot better in terms of the process, their underwriting, the entire actual experience of having to get a loan with them. Alternatively, you can go to some of the big banks, whether it's Bank of America, Wells, PNC, but I've heard some nightmares, to be honest, in some of these bigger banks. And so my experience, I've always gotten usually better deals with the smaller regional banks, if not community credit union type banks, and the process is much more hands-on. They're working there with you and they give you the attention you need. So that's where I would start. I would search locally. So the next question is, how do you find a great deal? I would say a lot has evolved in the real estate industry in the last decade or so. Most people would say, go find an agent, and the agent's gonna send you some lists, and then they're gonna take you around day after day after day after day to go look at a ton of places. Now, for sure, that's still part of the process these days, but frankly, my preferred approach is to first just see a lot of properties, and you can do this virtually. If you don't yet know what you want, start with making a list of all of the things that you want. And then you can go to sites like Redfin, Zillow, Realtor.com, whatever you prefer, and start to set up lists with the criteria that you like. And then with this, every day or every week, you can get all the properties that hit the MLS that will come straight to your inbox that you can click through, look at pictures, etc., and just comb through them. The reason I like this is, first of all, it gets you to see a lot of places, and it gives you a better sense of what you can get for your money. This is way easier than having to go out and look at a dozen properties in a weekend. That's exhausting. And so I would start there when you're in you're starting to think about wanting to buy a home for the first time, or again, whether you've done this before or not, but you can start to get into the habit of looking at what's out there. You can actually set your expectations of what you can actually get with your money without having to run around town with an agent. Now, it does help to actually go and see these places at some point. So you can take one of two approaches, and I'll tell you which one I prefer. One approach is find an agent that you really like, trust, and will go around several weekends or one weekend to go see as many places as possible. Now, generally speaking, you're going to want to do kind of the big bang approach where you're getting, 5 places lined up in a day, and you're going through to see all of them, and you can actually make a decision within a weekend. Now, it doesn't always happen this way, especially if you're particularly picky. In that case, you have time. You can wait for the right one to pop in the market and then just go see that one. That will also work. My preferred approach is to set up my lists on Realtor.com or Redfin. I'll see what comes in, and as soon as I see something I like, I reach out directly to that listing agent. Now, the reason I do this is because that listing agent, if I go to them and they also represent me on the buyer side for that same place, they're going to be incentivized to do the deal with me. They're going to want to try to either get some of that commission, which is generally, call it 5 to 6%, depending on the market. Generally, that gets split in half by the buyer and the seller's agent. Now, in the case where the agent is going to be both the buyer's and seller's agent, they have the opportunity to either kick some of that savings back to the seller, take the full commission themselves, and really just push the deal forward. Now, in terms of how long it takes to actually find your first deal, I would anticipate if you're doing this just for the first time, it's going to take you the better part of 30, 60, maybe even 90 days just to like get a sense of the market, what you like, what you don't like. Outside of that, once you get into the actual buying process, as soon as you make that offer, you're pretty much on a, call it 30, maybe 45 day time clock to get to the close. So that's what you should expect once you start getting into the process. So the next thing I want to talk about is how to make an offer. So generally, you're just going either to, again, your agent or the listing agent on the property. You can either verbally or through email just tell them what your offer is. They're going to fill out the purchase agreement for you, have you sign off. It can be sometimes a lengthy document, but mostly it's standard form template, but definitely read through it. Now, with that, when you're going to make your offer, you should have some context of what's going on in the market, right? Are there a lot of competing offers out there, which you can usually come to find out from the listing agent themselves? If that's the case, you may need to come in with a very strong above market offer. So I'll give you a couple strategies to consider. So let's say the first strategy is around low competition environment. There's little to no other offers. You may be first one to the table. In that case, you have probably the best strength in terms of negotiating. And you can generally negotiate several things. You can negotiate, obviously, your offer price. There's going to be things like closing concessions or closing cost credits that you can get actually from the seller. You can also negotiate things like repair that you want them to complete before the sale. You may not even want all of these things, but these are 3 points that you can bake into your offer to have them push back against something to actually get to the offer that you want. So, for example, you might come in with a super lowball offer and then also ask for closing credits and then also ask for some repairs. Well, now you have 3 things that are probably not ideal for them and they're going to push back, and then you can offer to give up on some of the other pieces of these and consider them to be kind of bargaining chips in the process. That's one way to go about it. The other way to think about it is, the start, the middle and the end. So in the middle, you have essentially the inspection phase. So a lot of times you can come in with a, low-ish offer on the front end, come into the inspection, and then do a post-inspection kind of renegotiation around the things that you want them to fix. Now, the best thing that I've heard or seen work when you go to do that post-inspection negotiation is actually take the inspection report, itemize out every little thing that they quoted, give a price tag to every little thing that they quoted, and then give them the full sum. This, when it comes back to the seller, a lot of times gets them thinking about and fighting over line item things rather than the final dollar amount. So rather than saying yes or no to this dollar amount, they might be fighting, no, it's actually this, and so you'll actually get to a slightly different value. One strategy to consider as you go into this that I prefer. Now, the other alternative is that you're in a highly competitive environment. In this scenario, it's going to be hard to guess what the right price is. What I would say though is, go in with the price that you think is strongest. And if you have room to go to the upside and want to go to the upside, you can insert what's called an escalation clause, right? And what this would allow you to do is say, I want to make offer for X, but I will escalate the offer to this price in increments of, say, $5,000 above any offer up until this price. So if someone else comes in with another offer, your escalation clause, if accepted, essentially will supersede that offer by some incremental amount up until that point. Now, obviously, if you get beat out at your top end price and other buyers are in there, then you're probably going to lose that deal. But frankly, you're probably better off, because if you're in a very frothy, bubbly type environment where you're getting that many offers on a house, probably better off that you pass on this one. Maybe you rent for a couple of years and come back to it after things have normalized. So what to expect on the home inspection. This is, usually probably for a normal house, a $300 or $400 expense, and something as big as this is a 4-family building. I think I spent probably closer to $800 or $900. But maybe not my favorite part of the process, but it allows you to get some comfort of what's going on in the house. It gets a professional in here to come look at things at a deeper level than you might have. It also gives you a second look of the property to see that everything's in working order and there wasn't anything you missed in that first go around. In my experience, most inspections have been pretty kind of copy paste, very kind of, they have their standard template form. They call it the same types of problems that are really big problems. Sometimes they do call it a good couple of key items. They'll give you ages and life expectancies on things like your roof, water heaters, furnaces, etc. That's super helpful, especially when it comes to the negotiation. In my view, it's worth the couple $100 that you'll spend in this, to give you a second view on the house and actually a professional's opinion, as well as giving you the opportunity to kind of retrade or renegotiate if you see anything that you don't like in the inspection. I would plan on a couple hours to do the walkthrough, maybe 1 to 2 if it's a smaller house. Shouldn't take that long, and then you're probably going to get like a 15-page report back from these guys, giving you every little nuance that you need to consider. So, closing, what to expect for closing, costs and all the things that kind of go into it. So, closing day can definitely be a very stressful day. A lot of times in terms of the costs that are associated, your lender is going to give you an estimate of everything to expect. So basically a breakdown of what your payment's going to be, what the interest is going to be, and what all your closing expenses are going to be. A lot of times the main things you're going to be paying for is the lender fees. There's a bunch of things that go on in terms of title insurance and all the fees associated with recording the property. In addition to that, you're going to pay escrow, such as any taxes, insurance that you need to put up front. And so the bank is going to tell you exactly how much you need for your down payment, plus closing costs, plus escrow, which is going to be, again, taxes, insurance, and things that you need to put into your escrow account prior to actually acquiring the place. Now, again, if you negotiated in closing credits or seller concessions, that will be a credit at the close, which you'll then either be able to use to offset all of your closing costs or some portion of your closing costs, and even some of your potentially down payment on the property. So great thing to negotiate in any real estate deal. So that's it, you're closed. The last thing I'll touch on, which I want to touch on because it's important as you roll things forward and think out into the future, a couple things to be aware of. So I mentioned before, if you're getting into an FHA or a low down payment loan, 5 or 10%, you want to be thinking about refinancing and what that plan looks like. Now, again, all you need to be able to do is prove out that 20% equity or 80% loan to value ratio. Now, typically, you're going to find that most banks will require that you'll need to be in the home for at least 6 to 12 months. It's called a seasoning period. But let's say it's 6 months. After 6 months time, and let's say you either bought really well or the market's appreciating a ton, and you're looking around and seeing all the houses around you are at this price, and you can value your house at that price, and that'll help you prove out that you have this 20% equity threshold. You can go to either your same bank or a new bank and say, hey, I want to refi, I want to potentially lower my rate, and I want to get into a conventional loan. You can easily drop that PMI that you would have incurred with that loan. So something to think about. Again, you can't bank on interest rates going lower. You can't bank on appreciation, but it's a good tool to have in your back pocket and something to be thinking about. The last piece I'll talk about here is HELOCs. Now, again, maybe a little bit more of an advanced topic, but something to be thinking about. If, for example, you do get into a home with a traditional 20% down mortgage, you can access that 20% by taking out something known as a HELOC, where essentially some banks will allow you to take up to 90% LTV or some even 100% LTV. Now, not all cases would I recommend that, but if you're using that money for other investing, personally, it's a strategy I like to implement. I would not suggest this just to go buy a nice new car, a nice new boat, because you are going to have to pay that down, and it's usually at a much higher interest rate than your mortgage. But it is one tool that you can consider if you do want to access some of that equity down the road. So that's all I got for you today on the home buying process. I hope you found something valuable in what I outlined in today's video, and will help you navigate your home buying process or whenever you buy the next piece of real estate in your life. Now, if you took anything out of the video today, I'd really appreciate if you smash the like button. If you'd like to see other videos like this in the future, be sure to subscribe. Otherwise, until next time.